from. Now, the last 6 months, of course, they've been great. Any idiot could have made money in the last 6 months. These are some of the returns from just the US stocks in the last 6 months. But obviously, the problem here is some things haven't done so well. Look at that. Telecom services. They're pretty they're pretty rubbish. Okay. Equally, utilities, as ever, are rubbish. Specialty industrials, rubbish. Okay. Financials, credit services. And you've seen the news about Visa today. Okay. Not great. All right. Semiconductors. Great. And we're not going to gamble on, oh, the market might turn around on these sectors. Oh, they're lagging. We're not here to gamble and speculate on what the future might hold because we don't have a crystal ball. What we're here to do is make sure the kind of companies we have are the type when the market rises, outperform the market. And if the market falls, don't fall as far as the market. Okay, so we get a win-win. That's the essence of what we're going to do. This is the last 6 months pretty much for the rest of the world in terms of the biggest companies in the world which are quoted on the New York Stock Exchange. So they're ones that you can access from the UK or the US. There's a whole bunch of UK companies in there as well. That's going to give us in total about 10,000 stocks we're going to look at. And I've always said to all of you, and most of you who've heard me before will know this, I treat companies as if they're CVs. So I want, when I'm hiring the 15 to 20 companies to be in my portfolio, because those companies that I'm going to invest in are basically managing my retirement funds and my son's inheritance, I need those companies to be the best of the best of the best. So those CVs, I want to sift through 10,000 to get the best 0.1%. Okay, just as if you're hiring staff in your company. That's how I look at it. And therefore, I'm also, just like when I hire staff in my company, not racist. I don't care if they're a Chinese company or Japanese or Canadian or American. So once I've got 10,000 companies to look at, and the data, by the way, and all your UK brokers and US brokers will offer all of these 10,000 companies, they're basically all the UK ones and the US ones. UK and US listed. I don't need to have access to the Vietnamese stock exchange for the simple reason, blimey heck, I've got 10,000 CVs. Why do I need to go fishing in waters which are even more difficult? Okay, so that's 10,000 CVs. So how do we, out of that 10,000 CVs, decide which companies? And I take a very bottom-up approach. So I don't say, oh, I want a bit of Chinese, I want a bit of Canadian, because I'm not racist. What I do is I start at the bottom up and I say, right, which companies are outstanding, regardless of the color of the skins of the management or where they originated from. Okay, so it's bottom up, not top down. It is not, oh, I want a bit of this geography, I want a bit of that sector. It is, can they make money and can the share price go up? In which case, I don't give a damn which sector they're in. We'll talk about diversification in a second. Okay, as the world becomes more global, it's harder to diversify, so there's less issue about having different countries. We're all too interconnected. So just at the first part of the webinar, in terms of where are we in the world? Well, that's the S&P 500 weekly chart, my friends. And that's since, that's over the last, 3 years? Wow. Okay. As you can see, what the hell are you going to do when this happens again? And that might happen again, that fall that we got. That could happen again. What are we going to do? What are you going to do? Okay. But look at that rally. Can it continue? Those are the two big questions. Can it continue? What are we going to do? Well, we are not going to be in the business of crystal ball gazing as to what's going to happen in the future. We're going to be in the business of controlling all that we can control, and that's it. What we can control is which are the companies which are good that we should have. We can't control the future, okay? If we could, we'd only have one stock, the one that's going to go up 300%, but we can't control the future, okay? And that's the FTSE, in case you're interested, which is pretty much at 2018 levels. Yawn, thanks UK companies. The 100 largest British listed companies, i.e. the FTSE 100, are worth the same as Microsoft. One Microsoft equals 100 of the largest British companies. That's same as 2018. If your pension manager or your IFA has only been investing in UK denominated funds or UK biased funds, then shoot him, because they're an idiot. Not just because of what's happened over the last 2 years, 3 years. That's actually at 1999 levels. So your pension's gone nowhere. Yeah, oh, no, it's all right, Alpesh. I got 3% in dividends. Great. Good luck retiring on that. Your IFAs have let you down. Pension managers have let you down. They're idiots. Okay, and if you want proof, I'll show you later on how I said back in 1999, stop looking at just your domestic bloody market. The gene pool is too small. If you're hiring people, would you say, I only want white people? Well, you would if you're a Yorkshire Cricket Club. But other than that, you wouldn't. You'd say, I want the best companies. I want a big gene pool to pick from. And that's what we're going to do. And that makes our life a lot easier. The average fund manager can't do that because they've got so much capital to manage. They've got to then have that capital divided into geographies like UK and style, UK growth, UK income, Japan income. So what happens? They've got a narrow gene pool, so they naturally fail in producing good returns. Our job's easier. We're not restricted by geography or style. We're just restricted by having top quality companies. That's since 1999. As you can see, the FTSE 100 in blue, in pound terms, is where it is. In dollar terms, it's still where it is. Okay. The S&P 5. Why do people keep asking if it's live? Yeah, it's live. I just slapped myself and it hurt. ASI, it's live. What do you want me to tell? Well, it's just said ASI, it's live. Okay. S&P 500, well, that's up 300%. So your American cousins, I've got American cousins, and luckily they're not 3 times richer than me over the last 20 odd years, just by virtue of being in the United States, because I also invested through a bigger profile. But I got friends who only did the UK. And so anyway, that's message number 1. Your pension stinks because your pension fund manager or your IFA is focused on getting kickbacks from UK denominated funds because they get bigger kickbacks because the US restricts that. I want to show you this. So let's look at the theme of inflation. And there's quite a few slides I want to get through. I'm lagging a bit in time, so I'm going to speed it up a bit more. These are all the exchange traded funds with inflation in the title. Those are the ticker symbols. Don't worry about this too much. All I'm saying is there's a shed load of money in billions going into funds which have inflation in the title, right? They're getting a lot of money. I can guarantee you there's going to be a lot more fund managers issuing new funds with inflation in the title, and they're going to want to scare you about inflation. Now, I'm not saying inflation is not something to be scared about, but they're making a lot of money out of the keyword inflation. Okay. Somebody says it looks sunny. It looks sunny where you are. I'm indoors. What sectors do well during inflationary periods? Sridhar, I just said, I'm not looking at sectors, looking at bottom up. I'm looking at what companies do well, full stop. I'm not gambling whether inflation is going to last or not. Economists are undivided, so I'm not going to gamble on whether inflation is going to last or not. We're not here to gamble. We're not here to gamble. Is crypto going to do well? Is blockchain going to do? I'm not here in the crystal ball business. I'm in the business of, are these companies going to do well regardless of economic environment, regardless of second guessing which way the economy is going to move? Why? Because I didn't see COVID coming. Did you? Did you see interest rates staying flat this long or rising? No, neither did I. So I'm going to make sure they're the kind of companies which, if inflation happens and stays persistent, they do well. If it doesn't, they do well. If I wanted to gamble on inflation, I'd go to Ladbrokes, okay? Because that's where the gambling's done, or at the casino, right? Similarly, which sectors do well, which is cyclical? That's the kind of stuff journalists love writing about. But if they had that crystal ball, they won't be journalists, would they now? Okay. So why do I say 50%? Well, over the last 12 months, and we do this every single month for the preceding rolling 12 months. So 12 months ended to the end of October, well, 29th of October, 2021. These were all the stocks from the preceding 12 months that we selected based on the criteria I'm going to go through, the process I'm going to go through, which were up over 100%. Well, all of our stocks are up over 100%? No. If they were, I would have just bought the one stock and doubled my money, guaranteed, and sat back. We didn't know which ones were going to go up and which one weren't. Okay, so those happen to be the ones which were over 100%. That doesn't help you. What if there were $1,000 I'm not telling you about, which were down 100%? So that doesn't help you. You need to see the whole figures. So in the 12 months ended 29th of October, so the end of October, the start of November, 12 months to November 2021. Why? Because I'm speaking to you in November, and we do this exercise every month. Okay, what's the rolling 12 month to December will be the next set. Okay, these were the ones. Sorry, it's a little bit blurry. Don't worry about it because you're not picking these. These are not the ones we're holding going forward. These were for the 12 months ended November. Okay, so then they're sold. Now we've got to look at what's the next 12 months. So I'm just showing the history first as to why I'm saying over 50%, what's the process, and then we'll look at the future. Can I guarantee 50%? No, I'm not a bloody bank account. I don't know what tailwinds and headwinds are going to be. If we get the same economic environment we had in the last 12 months, then yeah, I'm pretty confident we're going to get another 50%. If we don't, then I'm not confident at all. All I'm confident about is the kind of stocks we have will be the kind which generated this return, because we're going to use exactly the same process all over again, and we've been using it for about 20 odd years anyway. And some years we do better. Actually, normally we target 40%, but there's been a great tailwind. So some years you do better than 40, some years you do worse. So I'm going to show you the process so you can copy it and do it yourself, okay? So you can copy it and do it yourself. So these are the ones which generated 50 to 100% return. I wish all of them generated over 100% return, but that's not how the market works. Even though we narrow it down and we tick boxes on valuation, growth, income, cash flow, momentum, low volatility, consistent performance, what still happens, okay, is some of them don't hit the target. So what happens if they don't? What happens if they go the wrong direction? Well, I'll explain that. We have a trailing stop loss. We get out of those ones. Very simple. This is the entirety of the stocks. It's a bit blurry, but like I said, it doesn't really matter because this is historic. On my free Telegram channel, you'll see these. And if you don't know where it is, I'll give you the link again in a second. So on my free Telegram channel, you'll see some of these slides. So it's a bit crisper and cleaner. So guess what happened? Right, we had a few which were up 300%. Did I know it was going to be up 300% last November? No, of course I didn't. If I did, I would have just bought that one stock. Well, if you didn't know, Alpesh, you must be rubbish. Well, yeah, okay, I'm rubbish. Okay, but the vast majority, and by the way, the average is 53% in the 12 months ended November. Yes, we had a great tailwind. I don't take credit for it. The economic environment, thank you very much. If there'd been a massive headwind, we might have got 0% with the same stocks. All I'm saying is we made sure the criteria were good. These were the best players we could find. And I explained what the criteria are so you can copy the criteria. Pretty straightforward. Okay. And there were a few which were negative. There you go. They're over there. And there was some which was 0. And there was some which underperformed the market. Overall, the average of all of that is 53%. Now, let's say you say to me, Abhishek, but let's say you gave me those names in November, which I did to my followers. And let's say I didn't pick all of them. Obviously, you wouldn't. Let's say I just picked a batch tactically, and we'll come to that in a second. I picked just 15 or 20 of those. What if I pick the worst 15 to 20? I'd say, well, you're bloody unlucky then to pick that. What if I pick the best 15 to 20? Yeah, well, you did really well and you were very lucky. Okay, but let's just assume that any 15 out of random that you would have picked out of this would, because it's a subset of the whole, would have given the same return as the whole. So anyway, the whole was 53%. I'm only targeting 40%. To be honest, I would have been happy with 30% given bloody COVID and everything else. Okay, so what are some of the ones that we like at the moment? I'm just going to throw you a couple of names for the moment, but you really need to know, why do we like them? Well, yeah, okay, Hamilton Lane. But how did you get to that? Surely it can't just be on a discount cash flow. That's what that shows. Can't just purely be on discount cash flow. No, we've got to look at more things than that. There's different criteria. So yes, that tends to be undervalued. Doesn't mean it's going to necessarily do better. If I thought it was the only one to go up, then it's the only stock I would have bought. S&P Global. Why? Again, it's undervalued, but that's not enough. That's not the only criteria. So the issue now that we need to look at is, well, what are the criteria and which other ones do you like? So I'm just throwing a few names just to keep you happy. Moody's. What are the factors you're looking at? Why do you like Moody's? What about the fact that in 20 days it could be down 40% based on how it tends to move, but over 250 days probably generate maybe a 30% return depending on the nature of the market? Whoa, Albish, that's a lot of information there. Could be down a lot in the short term, yes, because it's not a bank account, okay? But overall, well, wait a minute, which is it going to be? Is it going to be down 3% or up 76? I don't know, don't have a crystal ball. I can take a guess. The market, I always tend to assume in the next 12 months will be like what it was in the last 12 months. And you might say, you're a fool if you think that. Fine, I think it's as good a guess as any other. It's as good a guess as any other. We can argue the toss. If I'm wrong and you're right and more pessimistic, it'll be closer to this end. If I'm wrong and you're more optimistic, it'll be closer to that end. Simple. But I don't care about that. I care what we're pivoting around. So how are we gonna pick those names? I've just thrown you some names, but where do we get them from? Can't just pull them out of the air and say, oh, nice graph, discount cash flow. That can't be the only factor that affects stock prices. No, it's not. Take a picture of this. This is Morgan Stanley, Wells Fargo, and Goldman Sachs and their views on the S&P 500 for next year to the end of 2022. To the end of 2022. Okay, I'm not going to read it, but I want to show you something. Morgan Stanley say the S&P will be down to 4400. Goldman Sachs say 5100. What's that? A bloody 25% difference. That's a 25% difference. That's massive. Morgan Stanley, Goldman Sachs, wait a minute, shouldn't they all be thinking alike? They went to the same universities. They've got the same friends. They eat and drink at the same places. They change jobs and go between each other's offices. Why the hell is there such a big gap? And that's my point. If they knew, if they had a crystal ball, you don't think they'd have said it? Okay, so my point to you is this: there's a level of uncertainty, and therefore we narrow down and remove the rubbish stocks as much as possible because we do not know what's going to happen, right? So when people say which sectors, which geographies, that's great if you're a journalist, but none of you are journalists, okay? So yeah, sure, when I'm talking on the BBC, right, and I'm putting my sort of journalist hat on, I may well talk about China or a sector or whatever, but that's got nothing to do with picking stocks for your bloody SIP and ISA, okay? And it's really difficult. Sometimes you've got to make the same point over and over again because some people are a bit slow on the uptake on that because they've been drilled and conditioned so long with the nonsense that's out there that, oh, I've got to know the right sector and country. No, we've got to know the quality of the company, okay? So let's get into that. Equally, I'm going to share data in this webinar on things like this. This is Michael Burry, the guy from The Big Short, who foresaw the financial crisis. This is what he owns at the moment. That doesn't mean I go out and buy it. All this data is freely available on the internet, but it doesn't mean you go out and run after it. So what? So what? You've got a ton of information, right? So the problem you're facing today is, oh, what should I follow? Should I do that? Should I go long Facebook? What does Alpisha own? Actually, I do happen to own Facebook and Alphabet. You can argue with me if you wish, but there's a whole bunch of others. Just because he owns them isn't why. We need to be independent. So I'm going to give you an independent process. The other question you've probably got at the moment is, Alpesh, the market's at an all-time high. You're an idiot asking us to go into the market. I don't have a problem investing at all-time highs. This is data from JP Morgan's private bank. These are the returns over those periods if you invested in the S&P at an all-time high. You still got a 14.6% return the next year. That's the index. If that's what the index does, I should expect to do 2 to 3 times better than the index. Okay, over 3 years, 50%. So I should expect to at least double my money over 3 years from buying at an all-time high. All right, that's interesting data. So a lot of people say, no, it's all-time high. I'm going to wait for the pullback. Well, actually, you're not as stupid as you might think if you wait for the pullback. This is data from Eugene Fama. Now, Eugene Fama is somebody I've written about in my Financial Times columns and in my books. When I started writing about him, he hadn't yet won the Nobel Prize in Economics, which he has now. And what he's discovered is, there you go. There's the averages. After a 10% market decline, so you're fine as well. You know, your returns after a 10% market decline or 20. So those of you who are waiting for a 10, 20, or 30% market decline, guess what? You'll be fine as well. I hope you took pictures of this. I can't keep going back and forth on all of these, but I'll try and share as much of these as possible, okay? And for those worried about the bubble, I'm not saying there isn't a bubble. There are some bubbles, okay? Look at this. The blue is the NASDAQ for the 5 years ending March 2000. You know, the big dot-com bubble? That's the blue line. The white line is the 5 years ending up till now. So you could argue we're nowhere close to it. I'm not saying there's a bubble or not. All I'm saying is I want the kinds of stocks in my pension and my son's ISA, which if the market should crash, won't fall as far. But it's not a bank account, so they will fall. Even the mighty Microsoft, which is probably the safest company I can think of, will still fall, as it did during COVID and the financial crisis. But they're the kind of companies which won't fall as far and will rebound more afterwards because of the flight to quality, as that one did, just as an extreme example. So my job for my family and for you guys is really simple. And write these numbers down: 12, 15, 25, 40. Okay, 12-month holding period. Right? I do not, just because for the last 12 months I've had some great stocks, which I showed you earlier, doesn't mean, oh, I'll hold them for another 12 months. The market doesn't care that Alpish Patel had some really great stocks in the last 12 months. Let's do him a favor and for the next 12 months be really nice to those companies again. The market doesn't care about that. So I'll reanalyze it after 12 months. So that's where the 12 comes in. Why 12 months? I'll show you the Goldman Sachs slide on some of the research they did on why. 15 stocks is roughly what I own. I'll show you why 15. Could be 20 if I was more risk averse, 25 if I was really risk averse. Under 15, don't really want. Why don't I want under 15? Well, you saw earlier the graph which showed, even with all my analysis and filtering, there were still some companies which went down. If I only picked one, let's take an extreme example, I might pick the one which went down. Okay. 40% is what I'm targeting. on average. Some years more, some years less. Why? Well, 30% of that is going to come courtesy of one formula from Goldman Sachs. So it's not me, it's one that's stolen from them, which I'll share with you in a second, okay, and the names which it's generating. And then the extra 10% should be my skill. So it's not really calling upon much. Some years it'll be less, like the financial crisis. Ain't nobody got 40% that year. And other years it'll be potentially more, like the last 12 months ended just now up until November. That was 53%. So thank you very much. My job is to try and convert for my family every 10K into 100 and every 100 into 1 million. Simple, obvious goals. I mean, they're round numbers. Why not? What other numbers would I want? These are some of my students who followed some of the stuff, and I give them little medals if they've followed what I've said and if they get 100% return. So Crocs, Etsy, Medifast. I was with Ravi earlier. I don't know, Ravi, if you're on the call, and some of his. Anyway, so let's go down. So again, I said to you earlier on, one factor might be valuation, but that's only one factor. So when I look at these companies, I'm going to share with you the criteria that I have, the 5 or so criteria that I have: value, growth, income, cash flow, consistency of outperforming the market. I'd probably add in there momentum as well. So I'll go through that. And yeah, there's some names like this which come out, which are then undervalued on a discount cash flow basis as well. And sometimes there are strategies which have got nothing to do with that. If you've been following me, you'll know I said with Marks and Spencer's, I expected to get 100% return in the next 2 years. That had nothing to do with my usual process of value, growth, income, momentum, cash flow. It had everything to just do with what you see on screen. So sometimes I do that. It's out of the norm. You can ignore the non-normal ones or the special situations if you wish. Let's not confuse ourselves. Why did I say 12 months? This chart from Goldman Sachs, what it shows is institutional holding of funds has increasingly become a 12-month duration period because the world's moving faster. We can talk about this at some other point. This is from Goldman Sachs Global Investment Research. We can talk about that later if you wish. Okay. Eric, I'll answer your question later on. Some of the others I'll catch up with a little bit later on. The profession I'm in, asset management, the most useless profession in the world. I always say this to my students: if you learn something from me and you make good money as a result of the education, please consider doing something useful with it. I happen to be co-chairman of this charity with Lord Billamoria, the founder of Cobra Beer, and who is the chairman of CBI, Confederation British Industry. Qatar Lavani, you might know, his son's on Dragon's Den. Anyway, do consider it. Not that one necessarily, any, but, you know, because the money is the easiest hard money you'll ever make, or the hardest easy money you'll ever make. So what are the factors? Okay, forgive me for having preached. What are the factors? Well, there's valuation, but the problem with this is, Alpesh, what valuation? I don't want to spend my life reading about price earnings. I don't want an economics degree. Price earnings growth, price to book ratios, price to sales, discount cash flow. And which one of these is better anyway? Okay, so when we were doing the research, which I've taken all my research from all the stuff that I published in my FT columns, so it's not as if it's some kind of secret laboratory stuff. I published it in my columns and in my books anyway, and it's research which I've taken from others, i.e. people who've won Nobel Prizes, and we've put it all together, and then we take the stuff out of Goldman's, and we take the stuff out of our own experiences in the hedge fund industry, and we put it all together, and we say we want to tick every single box. So we want to tick the valuation box. We want companies to be undervalued or well valued, not overvalued. Why? Because we know there's a direct correlation between the valuation of a company and its subsequent share price movement. It's not a hard and fast rule. There are exceptions to that, but there is some correlation. So we know it's a factor worth considering, but it's not the only factor. Similarly, with a company's growth, we know it's a factor worth considering because we've seen the data, but we know it's not the only factor, and its weighting can change. So we want to tick the value box, and we want to tick the growth box, growth in sales and earnings. Earnings means profits, and growth in cash flow. Well, Alpesh, that leaves a lot of companies who might be unprofitable and about to go bankrupt, but somebody comes and saves them at the last minute. You're missing out on gambling on what might be saved at the last minute. That's right. I'm not in the gambling business. There might be some companies I miss. So what? It's like picking a football team. Oh, great. I picked Ronaldo and not some other forward. So what? As long as I win, it doesn't matter. Well, probably Manchester United is not a good example to give if you want to talk about winning, but, you know, Man City. As long as you win, it doesn't matter. As long as you get your return, it doesn't matter. You didn't pick every single great company. Okay, so I need to tick the valuation box, the growth box. Now, this already puts you at an advantage because, first of all, you're looking at 10,000 stocks that you're going to filter down. That's the first thing. So you've got a bigger gene pool to select from. And secondly, unlike fund managers, you're not just going to look at value or just growth. You're going to look at ticking all those boxes. So instantly, you're going to do better all of a sudden in any event. Okay, so then what have we got? We've got income. And by the way, none of this guarantees the future. If you're looking for a guarantee, you'd have to be congenitally stupid to think that means everything is always going to go up. Again, you shouldn't be investing if you're looking for guarantees and a bank account, because even after all of this, you could still have companies which don't do incredibly well. Okay. Yeah, Hannah said you can get a lot of this data. You can. It's fantastic. You can. It's just people don't do it, do they, Hannah? All this data is freely available on the internet. That's the beauty of it. You can go on the internet and get all of this. And it's not a big deal getting that information. You're exactly correct. And that's the beauty of it. The problem isn't getting access to it. Like Yahoo Finance. Hannah said, oh, you can get a lot of this data from Yahoo Finance. Exactly correct. But people didn't know to do it. They didn't know how to use it. So valuation, growth, income, dividends, and earnings. I'm going to tell you specifically what to look for. Momentum, I want the stocks to have done well over the last few months. And statistically, I want the volatility to be narrow, because there's evidence to show that lower volatility tends to do better than higher volatility. Again, we can talk about it in the Q&A and the data on that, but that's for later on. So wait a minute. I want to tick all those boxes so that I've got companies which therefore will naturally be resilient. So where's the evidence on some of this? So let me give you some of the evidence. So if we start off with those 10,000 stocks, by the time you look at valuation, growth, and income, you're down to just 50% of stocks which meet all of that. By the time you add cash flow, and I'll tell you the cash flow formula in a second, then you've got 25%. By the time you look at all the other things, you're really down to about 2%, and that's good, because we want to really narrow it down. You're only concerned about 15 to 20 stocks, and those 15 to 20 should, with a fair wind, as they did over the last 12 months, give you a 50% plus return. But let's say the market isn't quite as good, you might get 40%. If the market's rubbish and there's a crash, you're getting 0% in the next 12 months. Do you understand? If there's a crash tomorrow, and my crystal ball doesn't tell me, but I'm pretty sure there won't be tomorrow, then you'd be getting 0%. All right. But at least you'll have the kind of companies you won't lose sleep over. And that's the other thing. Okay. And these are just some of the tools that we've used to get the analysis from. So in case you're wondering about what's the pedigree of the stuff, there's been a lot of research. This one's called What Has Worked in Investing. I'll tell you who else is research. And this is the kind of stuff we'd look at. We'll look at, well, what happens if you look at the lowest PE? What happens if you look at the highest PE? What's the compound annual return? Is there a correlation? Yes, there is. And so on. You don't need to worry about all of that. And then we looked at the research of these three people in particular. They happened to then subsequently win the Nobel Prizes in economics, so that's good. Okay, again, that's just background. And I've had it published in all of this. So all of this stuff that I'm talking about has been published before in my books. And then we set up a hedge fund and a private equity fund. We've got no conflict with you because we don't have a retail fund. We don't have retail clients because institutions write bigger checks. No offense, but they do. This is my first column in the Financial Times in 1999. I don't know if you can see what I've written there. Okay. You should probably sell up your entire UK holdings and buy only US stocks. My point being, a lot more to choose from. And that's what I went into. Bigger gene pool. And that's what we're talking about. Bigger gene pool. So I don't want you to think, oh, well, yeah, this is a new thing. I'll bet you talking about the last 12. No, I'm not. I'm talking about the last 21 years. Okay, and I'm going to source the data and give you the processes now. And we have taken stuff. It's not me. I'm just standing on the shoulders of the research done by the academics, the Nobel Prize winners, and the investment banks who've got millions to spend on research. And we put it all together. See that where it says investment research? Chief Investment Office, investment research, we steal from everybody. Okay, we steal from them, steal from the rich and give to you. So first of all, what's the end goal? And then what's the process for value, growth, income? What's the formula? And then how do you narrow that down tactically? So tactically, you might say, oh, I want to specifically look at certain sectors. Well, it's up to you, but as long as it's within the strategy of value, growth, income, cash flow, consistent performance, it doesn't matter. But let's look at the goal first, and then I'll tell you the process, and then I'll tell you all my names that I like at the moment, and my son's portfolio holdings and mine. I've done screenshots of those. Okay, so first, goal, process, names. Goal, assume you plan to invest over 10 years, and with some of the stuff I'm teaching, you only make 20% per annum, okay? Not 40, not 50, because last year was good. Some years you might make less, some years more. 20%, not extravagant, given that the market just in the index alone will generate about half of that. Okay, let's say you got 10K in your 401k, SIP or ISA, and you plan to add maybe 500 a month. So nothing extravagant. You might be in your 20s, early 30s, because you've only got 10K. And we'll do the richer person example in a second. Well, on that basis, you'll have 600,000 in 15 years. Why? Because that's what it'll look like. You'll have 600. So you'll say, oh, that's compounding. I've heard of that. Piss off. I've heard of that. Alpesh, you're boring. Yeah, you know why people don't do it? This bit. Look at the first 5 years. Barely moves above your contributions. Barely moves. Compounding, the reason people don't do it, and all the people who blag on about it being the eighth wonder of the world and go, oh, look at me, I feel good, I keep talking about compounding. What they don't understand is human psychology. Human psychology, after 5 bloody years, has got in its portfolio pretty much the same as it contributed. Of course it's not interested. No, what's got to motivate you is the tail end, that over 15 years you've turned, and this is basically my son's junior ISA, because we max out his ISA allowance each year. So where is he at the moment? At 3.5? Well, actually, you only need to look at the market. It's been quite a good 3.5 years in the market. So he's a little bit above that, and I'll show you his portfolio in a second, but he's a little bit above that. And you might think, yeah, not much though, Alpesh. Yeah, well, the idea is by the time he goes to university, the spoiled little bugger will have about $500,000 from his ISA, tax-free. Spoiled little git. Assume you plan to invest over 10 years. Now, let's take somebody slightly different. And with my help, make 20% per annum, same as before. So not the 40, right? Let's say you've got 100K in those accounts. You also plan to add 1,500 each month to your portfolio. Okay, 1,500 each month. All right. You will have over 1 million by the end of 10 years. That's the number. So if you've got 100K now, 1,500 each month, that's your figures. Got nothing to do with me, right? It's to do with the fact that the people at the companies you're going to invest in will be working hard to get a return, and God willing, the markets will some years go up, some years goes down. Let's just assume for the next 10 years, they're not going to just keep going down, 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 down. If you thought that, you wouldn't be in the stock market at all. But anyway, that's what it looks like. So my job, sometimes I put it like this. I say to people, I say, how much is in your ISA? And I say, oh, it's $250,000. Let's say you got 250,000. If you get a 10% improvement from what I'm teaching you on this webinar, you'll have made £25,000 in that 1 year. A 10% improvement on that 250,000. And it happens time and time again. So keep watching the webinar, because you might, if you've got 250,000. In fact, you can put in the chat box. It's confidential. All the messages are private. So you can put in there what you've got in your SIPs and ISAs. Feel free to put it in and work out 10% of that. Why do I say 15 to 20 stocks? Remember those numbers? Well, this is the reason why. Okay. Company-specific risk, you can pretty much eliminate, but you can't eliminate market risk. Okay, now you might say, no, Alpesh, if I put into different sectors, right, it's all right, I'll be diversified in different geographies. I'm sorry, that's wrong. You've been misinformed, you've been lied to, or you're deluded, because the data shows when the markets fall, which is when you need diversification the most, everything's correlated. Correlations increase to the downside. If you don't believe me, go look at what happened to Costco, a retailer, and Microsoft last March. Both fell. Both fell. Okay? Give or take. Both fell. Oh, no, but Alpesh, they're in different sectors, so they should... Oh, right. Oh, God, shit, you're right. No, Alpesh, I'll do it by cap. I'll put some money in some Vietnamese stocks. Good. Go for it. Since you know so much, you can leave now. But that's why I say 15 to 20 stocks, and I really want good quality companies. And I don't care if I'm overweight a certain sector, because it was naturally out of the quality of the companies coming out of there. Just because those companies generate lots of cash and profitability and they happen to be in the same sector because that sector's booming, so be it. Okay. One other reason I don't like active fund managers, retail-only fund managers, look, I said, they limit things to, oh, ours is only US, only large cap. Great. Or UK growth. Geography and style. Narrow gene pool, going to mess it up, let alone their fees, so their kids can go to private school. You learning what I'm showing you now, doing it yourself, there's no fees involved. Guess what? You get to keep all of that. And this is, like I said, the biggest problem is this poverty gap. See that at the bottom over the last 5 years? That in red is the UK. I've made this point before, so excuse me. That in blue is the NASDAQ. That in orange is the S&P 500. Okay, you can play with those figures all you want, but over roughly since the Second World War, every rolling 5-year period, that bloody gap keeps existing. So British pensioners are getting poorer. I want British pensioners to be richer. So I want them to invest globally, because guess where they spend their money? Back in Britain. I want them to be richer. partly because I'm British. Okay, don't worry about that part. The typical fund manager, 40 stocks, all do rubbish, stupid names that they end up picking, and you can outperform them. If you think I've got a big mouth and I don't put my money where my mouth is, I did. My whole reputation. 2004, the FT said, you've got a big mouth. Why don't you risk your reputation against proper fund managers like Neil Woodford? Yeah, so I did. And the editor's cat and all the rest of it. All right. That's him in 2017, apologizing. I came top and won that competition using the exact same stuff I'm teaching you now. And how much are these guys charging you? Which is why I want you to be educated. At least you can ask them, why the hell are you charging me 10% of my money? Investment, £10,000. If you cash in after 5 years, £1,000 total cost. They're taking 10% of your money every 5 years and underperforming and tracking an index. Less costs. That's why, look, keep your money with them if you want. All I'm saying is at least you've got the education then to ask them, what the F, dude? What is going on? How come? Or your IFA. I want to tell you something right at the end in terms of some of the technology and stuff that we're spinning out of the hedge fund right at the end, something we want to float on the stock market. But I'll ask your permission now, only because sometimes people say, right at the end, Alpish, everything was great, but at the end you talked about yourself and your future. We hate you. So, value, I want to go now into the last 15 minutes. Value, growth, income, cash flow. Get your pens and papers ready in your phones. Return, consistent, volatility, outperform. That's the strategy. Okay. As long as a stock meets that strategy, then I don't care whether tactically it meets one of my other 6 tactics. And in fact, you could even ignore the tactics. I don't mind. So strategy is important. A subset of strategy is what's called a tactic. Tactics are irrelevant, but people, they like tactics. They go, oh, Alpesh, I found this stock. It ticks the box on value, growth, income, cash flow, consistency of returns, low volatility, outperforms of the market. But some of the gurus own it, so I really want to get it. Now, the mistake most people make is they do it the other way around. What they do is they say, oh, a guru likes this stock, so I'm going to buy it. Instead of looking at, well, actually, value, growth, income, cash flow, returns, consistency, they do it the wrong way around. Or they say, oh, you know what? I heard a bank likes this, or an analyst likes this, or a journalist likes this, or a hedge fund likes this. Instead of, has it ticked your process? Value, growth, income, cash flow, consistent outperformance of the market on low volatility. Okay. So, and I promised you earlier on, I'll give you the free book. So there it is. I said, you don't have to wait till the end. Okay. This and those books free to download as well. If you want to look back on some of the research that I've done and published and why, and the basis of it. Okay. So that's the URL for that. Like I said, get your phone ready. So, so once we've narrowed it down by valuation based on, I'll let you into a secret. I don't care which valuation metric you use. I need you to use a valuation metric. So it could be a PE ratio. You might say, PE ratios are rubbish. Nobody does them. You're right, except at least it'll give you one aspect of valuation and it's more about avoiding the rubbish overvalued companies. And then growth, revenue growth year on year. Cash flow, I'll give you the formula in a second. Lower volatility. Volatility of Microsoft is about 9%. So by low volatility, I mean really things beneath about 22% volatility. Okay, I want a positive dividend yield. Why? There's correlation between dividends and the ability of a company to resist a shock, a fall to the downside, because otherwise its yields go up and therefore people buy into the stock. So it won't fall too far if it's got a positive dividend, and that's better for me. I'm not saying if a stock doesn't pay a dividend, it can't go up. It can, but it's a factor to consider. So once we've got those factors, and I'm going to go to cash flow in a second. Okay. Investing tactic number 1 might be what the gurus are buying. Now, just because, and I'm sharing here the top 10 holdings of Bill Ackman, and that's what his portfolio is worth, 10 billion. I'll show you my portfolio in a second and my son's. Okay. So give me 1 second for that as well. Okay. That's Bill Gates, 23 billion, and that's his 15 stocks. Now you can take a picture of that, and forgive me if it's a bit, just take a picture of, I don't want people to complain, I couldn't see anything. That's not my fault, is it, if you can't see anything, but please take a picture or video, whatever, of that. Carl Icahn and George Soros. Now, just because they own these doesn't mean I'll go and buy it. What I'm saying is I want you to be empowered and confident to know you've got your process, value, growth, income, cash rates. You're ticking every single box. So if the market tumbles, you can still say to your spouse, it's okay. Value, box, ticked, growth, income, cash flow. Now, if you want to say to your spouse, The market will never tumble, and if it might, I'm going to be scared. Then don't invest in the markets at all, okay? Because all investing is risky. So we take all the gurus. What happens if you took all the big gurus, the big billionaire investors and the big family offices, and then look to see which stocks they all own and have in common, and then color coded that? This is what it would look like. The darkest green that you can't quite see up there is Amazon. Okay, but that doesn't mean just because more of them own these stocks in the darker the green that I'm going to blindly buy them. They still got to meet my strategy: value, growth, income, cash flow, and so on. Okay, but what I'm saying is, by this approach, now all of a sudden somebody says to me, "Hey, Bill Gates has just bought more Microsoft stock." I'll say, if he were to do that, I'll say, "Well, let me just check if it meets my criteria." Oh, it does. Great. I might buy that then. That's the tactic. Do you see the difference between tactic and strategy? Now, this is one of my favorites. It's been a good time for it, but please, risk warning. Risk warning. Anything to do with leverage is always higher risk. Okay, so these are my holdings, or some of my holdings over the last 12 months, and these are some of my sons as well. Okay, and he's 3.5, so you can assume I've done it for him. Although he does come into the room now when I'm watching football and say, Daddy, put on stock market, by which he means Bloomberg. To see if the colors are green, not red. Anyway, that's Costco. This is Costco, okay? So I'm going to explain this to you. When I said leverage big on lower risk, I'm looking for stocks which have this kind of profile. There's very few stocks which over a 250-day period would, based on their recent performance and history never repeats itself, are likely not to have a negative return. That's statistics. Wait a minute, Alpes, you didn't talk about supply chains and all of those things. No. Because guess what? A stock is also a statistic. It's a data point. Companies have accounts after all, and they have share prices. They have accounts. They have 3 sets of accounts: balance sheet, cash flow, and P&L, profit and loss account. And they also have data, which is their stock prices. So there's a lot of things you can look at, lots of ways of skinning a cat. So for me, Costco, I'll leverage. How do I leverage it? Either I can use an exchange traded fund or I can use a CFD. That's complicated. We can talk about that in the Q&A. That's higher risk because it's leverage. Here we go. Okay, so what have we got? Wisdom Tea, 3 times daily leverage. That's up 209%. That's not since the last 12 months. That's about the last 3 years, I think. But you can do the math. You can just have a look on the internet. Microsoft, I double leveraged it. Why? Because its stock performance looks like this. So it's a lower volatility, lower risk stock. And how the hell did I get 153% return in the last slightly over 12 months? But you can look it up. Because it's right up until about an hour ago. That performance is up to about an hour ago, so you can look it up. Apple, how did I do that on the leverage one? Well, because it was leveraged. Okay, I'm not saying everyone should leverage, but I'm just saying, okay, Danaher, Net Company, and so on. Now, some of these are obvious. My wife always jokes, she goes, are you seriously going to tell them Alphabet and Amazon? Any idiot can do that. No, ignore those for a moment. Okay, these are for my son. Cadence you didn't know about. Fortinet you probably didn't know about. So how did we go about then the leverage part? So I find companies like Costco, and there's very few. Costco, Microsoft, Oracle are the few. And occasionally, whenever I find a new one which has that kind of profile, then I'll share it in a webinar. Strategy number 3, tactic number 3, what banks are telling the richest clients. So yes, once it's met our criteria, our strategic criteria of value, growth, income, cash flow, I know I sound like a broken record, then we might say, well, what are the banks telling their richest clients? Oh, Citigroup, they said last April, so this is in April 2020, I said it could go from $42 to $70 because the $78 was the bank target and it was at 42. And I said, that gap is too wide. Have you noticed how the banks are always over optimistic on targets? So I said it'll go from 42 to 70. And of course, we had a tailwind. The market helped me be right sooner than I thought and did better than I thought. Okay, similarly with Capri Holdings. So this is the tactic of once it's met our strategic criteria as Capri had, tactically, the bank's gap, basically the average price target was so large, we thought, ooh, let's narrow down on that one. So Capri, for instance, 7th of April 2020, we had it when it was at $12. The target was $30, which is 134% upside. As it happened, it just kept going up and up and up. Did I know it was going to go to 42? No. Did I think it was going to go to 30 at least? Well, yeah, I had a pretty good guess given that value, growth, income, cash flow, Sortina, all of those things got ticked. So we got the 250% return. If I knew it was going to go up 250% return, I would have auctioned my mother-in-law on eBay, taken the proceedings and put it in this and only this. So let's put some humble limits to my good fortune, which is, hey, there was a tailwind I didn't foresee. I didn't know it was going to go up that much. So you might say, well, you're a lucky fool. Fine. I'm a lucky fool. Disney. Again, it met our strategic goals, value, growth, income. So I want you in your processes to make sure you tick the value, growth, income. We could talk more about those in Q&A. Value, growth, income, cash flow, all of those. Then tactically, you might say, oh, I noticed that the analysts say there's a 44% upside. As it was, we got a 73% upside. That was actually, full disclosure, I don't think I bought that. It was my sister who bought that because she wanted one. She literally said to me, I want something relatively safe for the kids' school fees. And I thought, oh, shit, it's my sister. I better get that right. So I told her this one. Obviously, I'm favorite brother because she got 73% on that one. Uber, 85% return. What? Uber? You mean to say in the middle of a global lockdown, you thought Uber was going to go up March 2020? Well, yeah, because it met value, growth, income, cash flow. And then tactically, the analysts had that much on the upside. I won't go through all of these. Viacom was a great one. I did not see that coming that much. But what I did see was value, growth, income. So what I'm saying is I could control the selection criteria, but I can't control the tailwind. A bit like a pilot flying across the Atlantic. I can control the airplane, but I can't control the winds. Okay, it's a similar to that. So sometimes I get to London from New York quicker. Sometimes it takes longer. That was United Healthcare, 41%. Not surprising, given that it's a more stable, boring company. Okay, so what do we look at with analysts? Well, I'm afraid looking at analysts is not as simple as you might think. Of course, we want to look at the names of the companies, the track record of the individuals, how recently was the target, who else agrees with it. These are all various factors. So I want you to know the complexity. And even then, like if you look at all the individuals, who are they? Oh, he's from Morgan Stanley. Is James good at this? Who else agrees with him? What's their targets? Look how some of the targets are. Is there similarity? What's the kind of returns? That's Visa. Visa went down 5% today because of the Amazon news. Okay, so even then, did those analysts not know what Amazon were going to do? Why would they? Unless they were trading on inside information. Why would they? So my point is there's a limit to knowledge. There's a limit to crystal balledness. And that's what private investors often don't understand. Investing tactic, that should say tactic number 4. What do big banks tell their clients? Now, this is probably the most important thing. Okay, this is a game changer for me. When I first discovered this about, I don't know, 10 years ago. Okay, this is a Goldman Sachs slide, which their asset management division, the quantum database, Goldman Sachs Research, okay, Goldman Sachs Global Investment Research Team showed me, and it was their chairman who showed me. And when you're in the hedge fund industry, you get these presentations a lot, and it's very rare that one really catches your eye. And this one really caught my eye. This measure of cash flow. So I think you should have a cash flow measure. This is my preferred one, but you might choose a different one. But this one is cash return on capital invested. Now, you're not going to learn that formula. You don't need to. I'm not going to bore the pants off you with what it means. But essentially what it means is, what's the return of cash the company is generating on its capital? Now, what they discovered is companies which are in the top 25% by Croakey cash return on capital invested generate on average 30% return per annum. It's not me saying that. That's from Goldman Sachs. There's nothing I've told you today which I've originally invented other than putting what everybody else has said into one place. That's my innovation. Value, growth, income, cash flow, consistency of outperformance. That's what differentiates from everyone else. I've stolen valuation numbers and why they're important from someone else. I've stolen why growth is important from someone else. Cash flow I've stolen from Goldman Sachs, from somebody else. I put it all together in one place. That's the only innovation, okay, that I can take any credit for. I've stolen the notions on why we look at 12 months from Goldman's and from Nobel economist Eugene Fama. Why did I steal it from Nobel Prize winner Eugene Fama? Because I'm not a Nobel Prize winner. That's why. Who do you want it from? Him or me? Him, obviously. So, okay, top 25%, 30% per annum return. So they're doing it. It's not me. It's not I've got some secret formula that I'm an amazing genius. No, I just stole from the best. Okay, so that was theirs. Okay, now tactic number 6, I've sort of jumped around a bit. What are hedge funds doing? Again, in here you can see some of the hedge funds. I've shown you this earlier. So the hedge funds in here are Bill Ackman, Carl Icahn, George Soros, Leon Cooperman. Just because they're doing it doesn't mean we will. If it's in my what I call my approved list of value, growth, income, cash flow, consistency, outperformance, which is basically I measure it by Sortino and Alpha. Write that down, Sortino, Alpha. You can look it up elsewhere if you wish, but those are important. And yes, we'll look to see hedge fund. So I've got Globant. Okay, I've shown you my other stocks and my son's Cadence. I've also still got as well. Now, Goldman said recently, so I'm giving you more names. Goldman said, say, buy these 20 stocks. They have the most upside potential right now, including 5 set to surge by at least 50%. They get breathless, don't they? Goldman Sachs names 30 stocks to buy for double-digit revenue growth in 2022 and 4 sectors expected to beat the S&P 500 sales growth. Bloody hell. Okay, so we took their names, then we analyzed them according to my approved list. So these are ones which I hold because they were in my approved list. Okay, so they're the ones I hold of the ones Goldman Sachs mentioned. These ones I don't hold, but were in my approved list. Okay, and I don't hold, and they're not on my approved list. So, I'm not bothered what they say. I'm not interested. Thank you very much. Hopefully, you took a picture. Somebody once whinged that I don't give enough time to take a picture, so I'm going to pretend I'm taking a picture. So imagine this is a camera. Okay, I'll put it down. Should be enough time. That I showed you earlier anyway, which is part of my SIP. Okay. I've shown you that already, so you don't need it. I don't want people to. I'm being fully transparent. As part of my ISA, not everything on my SIP and ISA has gone up. As you saw earlier in the performance, some of the stocks were down, but there's a minority which are down. I mean, that's the whole point. I also like to share with people what are hedge funds like Night Owl. Any hedge funds which have generated more than my targeted 40% per annum over the last 3 years. What are they doing? So this one is Night Owl. What do I own? Amazon, Microsoft. I've got double leverage on those. Shopify, I don't, but it's on my approved list. MasterCard and Visa, I still own. ServiceNow. What else? Alphabet I own. Fiserv I don't think I own anymore. I think we exited 12 months or up. Facebook I own. Okay. I also look at any analysts who are generating more than 40% per annum over the last 3 years, and then cross-reference with what's on my approved list. So NVIDIA, when it was on the approved list. So even if it's on value, growth, income, and it ticks those boxes, but let's say next month it doesn't because it shot up, I'm still holding it for 12 months, okay, with a trailing 25% stop loss. So if it drops 25% from the highest it's been since I bought it, exit. Okay, trailing 25% stop loss. Which are in my list and what's their risk? Let's talk about risk as well. Well, these are companies which are in my approved list, but those are the probabilities that they could drop more than 20% in the next year. Okay, probability based upon statistical analysis of what if they move the way they have done over the last 2 or 3 years. What happens in the next 12 months if they do the same? And those are the probabilities. Take a picture. I'm not going to read all that out. Okay, I'm not going to read all that out. All right. Similarly, here's another bunch. Okay, and you might suddenly say, "Hey, hang on. I like Crocs, but 59% chance of dropping 20%. Thank you very much, Alpesh, but I'd rather go with Thermo Fisher." Okay. Whoops. This is not individual stock about. So S&P Global, I mentioned to you, undervalued. Tempo. But this only helps you for tonight. What happens when Uncle Alpesh is gone? So I want to tell you something that we've launched out of the hedge fund, which we think disrupts the fund management industry, disrupts the IFA market and the wealth management industry. And we think we can float this company in a few years because in the multi-trillion-dollar fund management industry, we think we've got something which helps people every year and doesn't charge them fees or subscription fees every day, every week, every month, every year. No ongoing fees either. So I'm going to come to that in a second. This is what we do. Okay, it's our process that I've just told you. So make sure you do this. 10,000 stocks, UK, US. Monitor infrequently because otherwise you're going to go mental. It's got one screen is all you need, not one strategy. Remember, there were lots of tactics. So one strategy, but many tactics. 20 investments, 15 to 20. Okay, that bit doesn't matter. I'll explain that in a second, right? 15 to 20 stocks is what I hold. Trailing 25% stop. Trailing. So if it drops 25% from the peak, then I'm looking to exit. There are some stocks that doesn't apply to for me. There's my quality stocks. There are 5 companies I consider quality companies where if it drops 25%, I'm going to buy more. Okay, and you can argue the toss with me on this, and you might disagree, but these are those companies: Amazon, Alphabet, Apple, Facebook, and Microsoft. No, if the market drops and they drop 25%, I'll buy more. I've not had the chance to see them drop 25%, I'm afraid. And that's what happens. So what we do is, that's how I make my approved list. Okay, it comes down to that, and there's got to be green lines across everything, not just a few, right across the board. It's got to be all greens. So why can I be so strict? I can be so strict because I'm picking out of 10,000 CVs. I'm going to narrow it down. That's why I developed a lot of this when I was still at university. Red Carnation, lost exam, perfected it, won those awards, wrote the books about it, because when you win awards, publishers like the Financial Times start chasing you. Wrote my weekly column. That is my most successful student that I've ever taught. She joined me as my assistant out of university and worked for me for 2 years. And now she has launched her own funds. She's moved from Newton to Polar, and she manages about 10 billion. My point is, I can teach anybody, including a 21-year-old English graduate, to pick stocks. Okay? I can teach anyone, because it's like driving. I can teach anybody to drive as well. I'd rather not. I'd rather teach you how to pick stocks than how to drive. But it's like that. It's not brain surgery, picking stocks. Okay? So we'd get asked by people, they'd say, well, why not do something with this? And we said, well, we're busy with private equity and hedge funds. So I said, well, wait a minute. What about launching some financial technology? And I said, no, because I don't want to charge people. I don't want to replace their fund manager with somebody who's also charging them fees. So they said, well, don't charge them fees then. Give them the data, but give them the education to show and narrow it down. So that's going to be our plan to launch that officially. And that's where we're going to make it broker independent, no fees. Just give them all that convenience. Give them daily alerts, give them whatever I own, but also more importantly, give them the whole shebang. So give them the education on what's value, growth, income, give them the evidence, give them the Goldman's reports, give them daily updates if they want it, though they don't need to, cash flow, why that works, Sortina, alpha, and the other factors as well. So it just saves them time. So they can just not have to be confused anymore. And that's where we came from. And I've been talking about it. You'll have seen me banging on about it and using my media profile. And I want to use the same media profile it's a spin out from the hedge fund. So the hedge fund owns it with me, and it's to spin that out and float it. That's the ambition. And of course, one of the reasons is the credentials of the people behind it. And, the lovely things, American Express say about me, and Merrill Lynch, and Centaurus Capital, which is a $2 billion hedge fund, and the BBC, and Coutts Wealth Management, and Financial Times, and so on. So we thought we had to do it. We tested it. Well, I say tested. It was fully launched with a group of people, and the reviews, we recorded videos with them, interviews with them. They love it. They're getting great returns. Well, the market's been doing well as well. So now, of course, that helps. And if you want to be part of that part of things, I've taught you what to do yourself. But if you want to be handheld by us, like I said, our ambition is to create $1 billion company. We want to float it. It's not going to be tomorrow morning $1 billion company. It's probably going to take 5 to 10 years before it reaches that kind of valuation. But because it disrupts $1 trillion market, we think we can take a chunk out of fund managers being poorly performed, empower private investors like you. And we don't charge daily, weekly, monthly, ongoing fees at all. The point is you get to keep your capital. So if you've got 100,000 and you make 20% on that, it's £20,000 you've made that year. And let's say you make it the next year and the year after, great, that's all yours forever. And you're in charge because you're educated and you're given the data. Education plus data, that's what it is. And that's our ambitions. If you want to be part of that, and I take on 10 people at a time, as many of you might know, who've been on it, then that's where you go. And I hope you will want to be part of that journey. We have got